everyone, welcome to the next installment of Charts and Perspective, where we use charts to dive into the world of economics and financial markets. I'm Jennifer Nash, an economic and market research analyst for TMX Verify. Today, we're going to highlight the major economic news from the week of July 28th to August 1st. This was one of the busiest weeks of the year for financial markets, with a plethora of economic data, a Fed meeting, and significant market volatility. I'm not going to give away too much, so let's dive right into the charts. First up, Q2 GDP. According to the advanced estimate, the U.S. economy posted a strong rebound in the second quarter, with real GDP increasing at an annual rate of 3%. This marked a significant turnaround from the first quarter's 0.5% contraction and surpassed the 2.5% forecast. Q2's expansion was primarily driven by a decline in imports and an increase in consumer spending. Next up, we have the PCE price index. The Federal Reserve's preferred inflation gauge was higher than expected, inching further away from the 2% target. The core PCE price index, which excludes volatile food and energy costs, rose 2.8% year over year in June, higher than the expected 2.7% growth and a slight pickup from May. The headline index also saw a higher than expected annual increase, rising 2.6% versus a forecast of 2.5%, and was up from 2.4% in May. Next, the July jobs report. The U.S. labor market is starting to show signs of trouble, as job growth was slower than expected and the unemployment rate ticked up. In July, 73,000 jobs were added, falling short of the expected 106,000 addition. However, the most alarming part of the report was the dramatic downward revisions of previous month's totals, which showed 258,000 fewer jobs that had previously been added were removed. Meanwhile, the unemployment rate inched up slightly to 4.2% as expected, but this is still near historically low levels. The other labor market headline was the JOLTS report. In June, job openings fell more than expected, hitting 7.437 million. Additionally, the report showed declines in hiring, quits, and layoffs. Overall, despite the slowing pace in hiring, the labor market remains in a low hire, low fire environment. And how are consumers feeling? We got a glimpse with both the Conference Board Consumer Confidence Index and the University of Michigan's Consumer Sentiment Index. In July, they both rose slightly, suggesting a recent stabilization in consumer sentiment, albeit at a subdued level. Both surveys also revealed consumers' inflation expectations continued to ease, though they still remain somewhat high. So how did the market react to all of this data? The S&P 500 posted its largest weekly loss in over 2 months, falling 2.4%. This followed its worst day in over 2 months, a 1.6% loss on Friday after the release of the July jobs report. The 10-year Treasury yield finished the week at 4.23%, while the 2-year note finished at 3.69%, the lowest level for each bond yield in 3 months. Another key piece of data from last week was the Fed's meeting. The Fed held rates steady between 4.25 and 4.5%, though this did take place prior to the release of the July jobs report. But after all the data came out, the CME FedWatch tool now shows a strong likelihood of an interest rate cut at the Fed's next meeting, with an 84% probability at the September meeting. The market is also pricing in 2 additional 25 basis point cuts for the rest of the year, one at the October meeting and another at the December meeting. That's all for our discussion. Thank you for tuning in. For more economic and market insights, you can find my content regularly on the Advisor Perspectives website under the AP Chart section.